Hello guys, welcome back to Olga channel. Alright, so today we are going to talk about pro forma analysis. Pro forma analysis. But before that, please subscribe to the channel, like and share. And I also want to tell you that God loves you. God is ever ready to help you understand whatever difficult topic that you are facing at the moment, and that I believe that at the end of this session, you'll be able to understand pro forma analysis perfectly, isn't it? All right, so let's dive right into this. So today we're using Excel to solve for the pro forma in order to aid the calculations. All right, so I'll share my screen. That's all right. So sharing my screen with all of us, and today we'll be looking at a question on pro forma analysis. Right, pro forma analysis. So basically, in every business setting, we want to know what the future would look like, right? We are not certain what the future would be, but then would want to take a look. Okay, so based on certain assumptions, what will happen to our growth, our sales growth, our assets growth, our equity, or in the near future, would there be a need for us to accumulate other financing in order to expand, or can we depend on our own resources to expand? So businesses or managers have so many questions about the future, right? So pro forma analysis is just a snapshot of how the business would want the future to look like, or of how the future would look like based on certain assumptions that the business or the managers will come up with. All right. So we have a question. So as we go through the questions together, there are certain points that might come up, and I'll explain you get it. All right. So we have a question that says the following are the financial statements of what? Yeah, Baby Limited. Use the information to answer the questions that follow. All right, so this is an historical income statement, but then we are required to prepare a pro forma income statement. So how the future income statement would look like based on some assumptions. And then this is the balance sheet, how the future balance sheet would look like. Will there be increase in the assets? Will there be any for external financing? So these are some of the assumptions or the questions that the pro forma analysis answers for managers. So these are the following. So after looking at the income statement balance sheet, we have fixed assets are operating at 75% capacity. So in every business setting, it was what preferable for our assets to be able to work efficiently. So we know that in every business setting, you can't just sell without a resource. So assets are just the property in the business that aid us in selling. So we use our assets to generate sales. So if you have a motor vehicle, use the motor vehicle to generate sales, because maybe you are using it for delivery. So you're selling the goods, it helps in generating sales, right? The other assets, the plant for the production to sell, or the warehouse to store the merchandise to sell. So assets helps or aids in the generation of sales. So the first asset for this firm, that's Baby Limited, is operating at 75% capacity. It's not using its assets to the full brim. So it means that its current sales is not equivalent to its full capacity. You get it. So that's the assumption. One assumption you need to take note that its current sales um is not using the whole, or its current sales is just using 75% of its total capacity. You get it. So the second one says cost, current assets and current liabilities vary with sales. That means that whatever happens to the sales growth will also happen to these costs. Because if your sales are increasing, definitely your cost will increase, but it's up to you to manage the cost so that you're able to get higher profit. If your sales are increasing, your current assets invariably would increase, because current assets include receivables, inventory, short-term investment. So let's say you are getting high, so it can mean that you are God giving more on credit, because sales is not only about cash sales but includes credit sales. So your current assets can vary directly with your sales. Your current liabilities you can vary directly with your sales, because you are selling more means that you might need more goods in order to meet the customer needs. And maybe your financing at that point might not be able to cater for that inventory you are going to buy. So you might want buy on credit. That's accounts payable. Okay. So that one too is because of sales, that's why you are buying on credit. So that's what we mean by vary with sales. That's whatever happens to sales is going to what invariably affect these items: cost, current assets, and current liabilities. All right. So the company paid 31.5% dividend, and they will keep this payable ratio. So in in some business settings, they pay, let's say, dividend to their shareholders. You get it, and it depends on the company's own policy. So it doesn't vary with sales. That's why they gave us this condition as a separate one. It doesn't vary. So the amount of sales I make doesn't determine the dividend that I'll give to my shareholders. It's based on maybe the net profit or any of the management decisions, right? So this company has 31.5 dividend um that's 1.5% as its dividend payout ratio. The percentage did not come back, it's a percentage. Then they said, what is the external finance needed to support 40% growth in sales? No new debt or equity issue. So our focus here, that's where the pro forma also comes in. That we want to, okay, so we've made up our minds that in the future we want to grow our sales by 40%. But then there are certain things that might limit us, because maybe our assets might not be enough to support this capacity growth, or our financing might not be enough, our equities might not be enough to support our debt. So this company or this question is asking us that with no new debt or equity being issued, that's debt being the same, but not issuing new equity. What external financing doing it? So we should also bear in mind that equity has two ways of increasing. One way of increasing is issuing new equity. That's you issue new shares on the market, people will buy, and your equity will increase, or your retained earnings will increase. So retained earnings move with what equity. All right, so your equity can expand if your retained earnings also increasing. Though you've not issued new debt, but because of your retained earnings, your equity will also what increase. So though the question says no new debt or equity is issued, doesn't mean equities figure in the old balance sheet will remain the same. But they just tell you that they are not giving out new shares. But since we have retained earnings, it can also aid equity to increase. But for debt, there's nothing like retained debt. So debt, since there are no issues, then the debt will remain the same. But equity will change, and we'll look at that later. All right, so we are so the question didn't say perform pro forma analysis for income statement or balance sheet, but based on the questions, and you know that you don't prepare pro forma analysis, you'll not be able to answer the questions. So that's basically it. So you have to know, okay, since it's about external financing, then it means that I need to prepare pro forma income statement and a pro forma balance sheet to compare and know what amounts do I need or would I need in the future to support particular growth sales growth. Okay, so we'll go to Excel. Then let's write the company's or let's write pro forma analysis. So that's pro forma analysis. Then the company's name is Yeah Baby Limited. Right. So that's the company's name. Then we have to prepare our pro forma income statement and then pro forma balance sheet. We are not told in the question, but based on the information given, we're supposed to know, okay, so this is what the question is demanding from me: a pro forma income statement and a pro forma balance sheet, right? So we have a pro forma. So we'll start with the income statement. Pro forma income statement. So we will use the information in the question, right? So we have our sales here. We have our costs. Then let's check what other item do we have. We have taxable income. Taxable income. And then we have tax, which is 40%. So you write all these in your book or in that's why I didn't write them before doing the video, but I'm doing it together. Okay. Then we have our net income. So our previous sales was 4,500, but then the company's goal is to expand sales to 40%, right? So it means that in the future, sales will be 40% bigger than what it is now. But the previous figure is 4,500. So how would we find the future, or how would we find the future sales? Yes, so the future sales would be the 4,500 times 1 plus the percentage, which is 40%. So in the future, sales will be 6,300. The reason why the formula is 1 plus 40% is 1 is taken as 100% of today. Today is 100%. So in the future, if you want to increase by 40%, the future it will be 140. You get it? So that's why we use that form. So you can write 100% here, you still get the same. But then let's see if we get the same. See, you still got the same, but we use 1 just for, I don't know, but we usually use 1. You can still write 100%. I prefer 1. And then our cost, because the question says cost varies with sales. So if sales is growing at 40%, cost will also increase or grow at 40%. You get it? Okay, so our old cost figure is 4,000. So here too, we will have 4,000 times 1 plus our 40%. Get 5,600. And what is taxable income? Taxable income is just sales minus cost. So the income you have that the government can take tax on, that's it. So it's just sales minus what? Costs. So we have our sales minus our cost, right? And then the tax is 40%. So 40% on your taxable income. So 40%, okay. So this taxable income times 40%. So your final net income will be your taxable income minus your tax. So give us taxable income minus tax. So our net income is 280. So currently our net income is 300, right? But then okay, so here is not 280, it's 700 minus the 280 here. So 420. So our current or our new income will be coming. So our new net income will be 420. That's in the future. So now it is 300, but in the future, if we project sales to be 40%, then our new net income will be 420. So that is for the pro forma income statement. So now we know that it's not difficult to prepare the pro forma income statement. Just know the assumptions that vary with sales, know the sales percent growth, and then just use the formula. The new or the old sales times 1 plus the percentage growth, we get it. So now let's move on to our pro forma balance sheet. So you prepare it for both. All right, so because you need information in the income statement to aid in calculation of some information in the balance sheet. Then we'll see that in few seconds. All right, so look for the items there. So in the or in the old balance sheet, which is this one, we have two sides. So the left hand side is the asset side and the right hand side is the liability side. Okay, so we'll do the same for this side. So we'll have our assets here, and let's say we'll have our liabilities here to differentiate. Okay, so here we have the current asset, here we have the fixed assets, then here we have the accounts payable, we have the long-term debts, and then we have our equity. And then don't forget that the question said what's external financing need that we are supposed to get to support our 40% growth in sales. So it means there will be an external financing need here. So you write that one to external financing need. So so now we are now coming to calculate for our current assets, our fixed assets, and then our external financing needs, our equity, and the others. So for the current asset, the question already said that it varies directly with sales. And since sales is growing at 40%, it means current assets will also grow at 40%, right? So we'll have it's equal to so our current assets is 4,000 over here. And it will grow at 40%, just as the sales, because it's very directly with sales. So 4,000 times 1 plus 40%, you get 5,600. Then we move on to account payable. The reason why I've skipped the fixed assets is because fixed asset does not vary directly with sales. Because in the question, you realize that the fixed asset capacity that is being currently used is 75%, right? So we'll do a calculation for that. But for now, let's look at those that vary directly with sales. Then we can move on. So with the accounts payable, from the question, it's 1,000. And since it's very directly with sales, so it's also grow at 40%, right? So we'll have 4,000 times 1 plus the 40%. That one will go as 1,400. Then our long-term debt, the question also told us that the long-term debt, or there will be no issue of what debt, right? So that's what the question says, that there will be no issue of what debt, no new debt issued or equity issued. So it means that the debt figure will remain the same. So we're going to look for our debt figure in our balance sheet. And sorry, that is 5,000. So we'll go back and then write our 5,000. Write our 5,000 here. And when we come to equity, the question also said that with equity, there will be no new equity issued. But we shouldn't forget that equity has other components, not just new issues, but retained earnings, right? So even if there's no issue, it doesn't mean equity will remain the same. So long as we have let's say net income in our income statement, and then we have our dividend, then means we can have retained earnings. So long as there's retained earnings, equity will not remain the same. So that's the assumption. So how do we find equity? So I'll write a formula here. So for equity, to find a new equity or the future equity is the old equity, right? That's the beginning equity plus our current net income. That's the one we calculated for in the pro forma. Okay, so let me write pro forma net income. Pro forma net income minus pro forma dividend. If A, so sometimes dividend is not a sure thing that it will be in the question. It depends on the question. If the dividend is not available, then means your new equity or your pro forma equity will be the beginning plus the pro forma net worth income. But if there's a pro forma dividend, then it means that you have to subtract to get your net equity or your equity. So in our question, we'll look for our beginning equity, which is what? 3,000, right? Our beginning equity is 3,000. So we'll write that one here. So here, this is not the where we put the answer. I'll put the answer here, but I want us to fish out the information, get it. So our equity, that's our beginning equity is 3,000. What's our pro forma net income? From our calculations, our pro forma net income is 6,300. So we'll write down one here. So plus, we have our 6,300 here. And minus our pro forma. So in our question, we'll go back to our question. You see that the question said the company paid 31.5 dividend and will keep this payable ratio, that's dividend payout ratio. So it's a percentage, but it was forgotten here. So there's a percentage here, right? So it means that in the future, we'll still pay out 31.5% of our net income as dividend. This is what we are paying currently, but in the future, we'll continue with this payout ratio. So dividend is paid out of our net income, right? So we can only give our shareholders some dividend if we have net income, and surely we'll have net income, right? So if we are paying 31.5% of the net income as dividend, then we'll come here. So our pro forma dividend will have 31.5% times our pro forma sales, because we're looking at the future. In the future, they told us that the dividend payout ratio will still be 31.5%, right? And dividend, we know that it's taken out of what? Net income. So if you're in the future, it means our dividend will be in the future. So we use our pro forma net income, okay, which is 420. Then we get 132.3. We get our 132.3. So now our equity here will be equal to this beginning balance plus the net income balance minus the pro forma dividend. And we'll get our answer if, oh, okay. So, sorry. So this 6,300 is not, so the net income is 420 rather. Okay. So 420. All right. So that's it. So the net income is what? 420, not 6,000. So that one was still sorry. It skipped me, right? So we have our four. So this are new equity. Okay. So our external financing need, we don't know that yet. We can only know our external financing need when we know our total asset. We know from our basis, that accounting equation, that our assets is equal to liabilities plus what? Equity. So in order to know the external financing, that's the need that or the amount we need from outside to support our assets, we need to know what our total assets will be first. So after finding our equity, after finding our long-term debt, we'll come to our fixed assets. So how do we find our fixed assets? Then we'll come back to our question. The question says that fixed asset is operating at what 75%, but it was supposed to operate at 100%, right? In order to be full capacity. So I'll get our full capacity sales. So in the future, if you want to know the what's fixed asset that we need to support this 40% growth, then we need to make some mathematical calculations. So first, we write here. So we are going to find our fixed assets, our pro forma fixed assets, right? So first, we know that our fixed assets, our current fixed assets capacity is what? Is 75%, right? But then our full capacity is supposed to be capacity is 100%. We've not reached there yet. Currently, we are at 75%. Then this 75% is giving us our old sales, which is what sorry, our old sales, which is 4,500. So this 75% is giving us 4,500. So we want to know, okay, so what if we had operated on a 100% capacity? Then what would have been, or what should have been our current sales, right? Our current sales is 4,500. But then if we had operated at 100% capacity, what should have been our current? So we want to know that full capacity sales. You get it? We need to know that full capacity sales, right? So in order to know that full capacity sales, so let's say if our full capacity sales was supposed to be 10, but then we are using only 5% of it, our answer will be our current sales, right? So our full capacity sales, right, is equal to our current sales divided by the what current fixed asset capacity, right? So our full capacity sales equal to our current sales divided by our current fixed asset capacity. So in other words, our current sales is equal to what? Our full capacity sales, which we don't know, times the percentage of what? Current fixed assets capacity, right? So this is it. So if you want to know your current sales, this is the formula. If you want to know the full capacity sales, this is the formula. I don't know the full capacity sales. So let's say full capacity sales should be X, right? And that is equal to our current sales, which is from the question, that's the old balance sheet, what 4,500. So 4,500 times, sorry, divided by uh what current space capacity, which is 75%. Okay, so 75%. So this is our current full capacity. This is our full capacity sales. So this is the sales that we should have what accumulated if we had used our fixed asset to 100 capacity instead of 75%. But we didn't get to that 6,000. But we have assumed that that is what we are supposed to get. So if our full capacity could have given us 6,000 sales, now our future sales is what 6,300. So we want to know what fixed assets do we need in order to support additional 300 to our full capacity sales. So in the future, we want to make 6,300 sales, which is higher than what our current capacity can do. So our current capacity, if used to the full brim 100%, will give us 6,000. But in the future, we want 6,300. So it means we need additional fixed assets. So in order to know what total or new assets you need in order to give you that 6,300, we use this assumption. So if X, that's our full capacity sales, sorry. So our full capacity sales is the 6,000. So if our current fixed assets, so which is what? Our current fixed asset is 5,000. So if our current fixed asset, right, assets could give us 6,000 at full capacity, then how much fixed assets could give us what? How much fixed assets I'm coming. So if the current fixed assets could give us 6,000 at full capacity, then how much fixed assets could what give us 6,300 what pro forma sales? So that's the question. And how do we find this? So using the statement, you said if our current as fixed asset, which is 5,000. So if 5,000 what? If 5,000 is equal to, if 5,000 is equal to what? 6,000. If 5,000 of our current sales will give us what? 6,000. If 5,000 of our fixed assets will give us 6,000 if it was fully used, then 6,300 sales that we want in the future, how much what fixed assets, total fixed asset do we need to support what that growth, which we don't know. So that's where the formula lies. So if more, since if 5,000 fixed assets will give us 6,000, and then 1,6,300, it means the fixed asset will be more. So if more, let's divide. So now equal to 6,300, right? So if more, let's divide. So this is more, then divided by less times this 5,000, right? So that is to say, so if I put it in words, that is to say, our pro forma, so let me write it here. So our pro forma fixed asset, right, is equal to our pro forma sales, right, divided by full capacity sales times current what? Fixed assets value. So this is all that I'm trying to say. So what I've written here is what I've written away. So someone might say, okay, so I don't want all these, I want just the formula. So that's the pro forma. So what the sales we want. So now you're looking for pro forma fixed assets. The fixed asset we need in the future to support our 40% what sales growth. And that is our, so if you want to know that figure, is what our pro forma sales, that's our future sales, divided by our current full capacity sales times our current fixed asset value. I hope that is okay. So now this year we equal to 5, we equal to this figure 5250, right? So now we've gotten our fixed asset, our current asset. So now we can know our total assets, which is equal to our current assets plus our fixed assets. But then we know that assets is equal to liabilities plus what? Equity. But let's look at something. If we ignore the external finance, let's see if our account will balance. So this account payable plus this debt plus this equity, we see that this side is not equal to this, right? So it means that we will need an external financing to support this what 10,850 what total assets. So that's why the external what financing need comes in. So to get this is we are what our assets. So this should be our final what value, that the total for what our liability side. So this total assets figure minus this account payable plus this, then this one will change to add this, and I've gotten here and here being the same. So this formula is not anything difficult. So if someone will say, okay, so I don't want this, just this asset figure, right? So here equal to this asset figure minus account payable minus long-term debt minus equity to give us this. So it's the same thing. It's just the formulas that have changed. So that's basically how to find what external financing need using pro forma analysis. So this is where I'll bring the video to an end, but I encourage you to watch it over and over again. If you have time, if you have any question, just leave it to the comment section. Please like the video, share, subscribe, and help a friend. And I know that the Holy Spirit force will help me. The way I've explained it is the simplest way anyone can explain to anybody. So I hope the video helps you. Enjoy the video, subscribe, share, and click on the notification bell. God bless you for watching. Till another time, it's goodbye.